So there are two basic scenarios, and we can start building two different templates with the audit. First one scenario is when you have completely new client which you don't know anything about it. And the second scenario is when you have continuous client which you already have some experience with. Make sense?
Yes.
Those are the two basic scenarios here in the audit. So once, regardless which one you're getting, or regardless which one you're starting with, you still need to do the audit planning. You still do to identify what kind of type of testing you're gonna do. And you still have to assess the materiality. Now, when you have a new client, your approach will be a little bit more difficult. Now, with the existing client, what you have to do is what's usually happen in the CPA cases, they're going to start showing events that happen during the year of the existing client. So based on the events, you have to start assessing the risk, which we're going to start doing today. We're going to start assessing the risk. But why do we need to start assessing the risk? Because we needed that for the audit planning process. So in the audit planning process, if you remember, let me share my screen with the previous chapter 3. So now we're going to make more sense everything. So first we're going to have the either new client, either continuous client. Once we do that, we have to do the preliminary engagement activities, and then we have to plan for the audit. So that will be the prospective client acceptance. So how we're going to do the prospective client acceptance. This is when we don't know anything about the client, and we have to think, can I accept this client or not? And I'm going to accept it only if I have the capability. If I don't have any connection with that client, and if the client complies with all the legal and relevant ethical requirements. So I have to protect myself in that case. Then we're going to, once we evaluate the client retention, if we're having with the continuous client, we're going to evaluate client retention periodically. And close to the audit, near the audit completion or after the significant event, we're going to check the conflict over the accounting audit issue and dispute over the fees. But that's only and only if there's a massive change in the environment that happened. So that will be any significant events that might happen in the client. Then what we have to do, determine the audit engagement team requirements, and we have to assess the compliance with the ethical and independent requirements. Once we do that, then we're checking the factors for evaluating the reliability of the internal audit function. Now we start checking first internal audit. Is there internal audit in place? Today we're going to see why we need this one. If there's internal audit in place, we have to test, is this internal audit actually work? How are we going to do that? We're doing that competence. We're going to check the competence, and so we're going to do the systematic and discipline approach. We're going to check is the company has the audit committee. Is this actually audit committee working, or is just on the paper and nobody cares what's going on? Then once we do that, assessing the business risk. In order to assess the business risk, we have to understand the entity and the environment that the entity works. Now, to identify the business risk, now we have to start looking closer when we understand the business, the environment in the environment, in the entity, then we can start identifying, is there any business risk that might affect us? And if we identify something, then we have to evaluate how the entity responds to those business risks. And we have to make sure that the responses to those risks are implemented. So if there's a risk, is there anything that the entity do to reduce that risk? And now, based on that information, now we're going to assess the level of the risk and level of material misstatement on the financial statements. So how are we going to do that? We're going to establish first the overall materiality. And after establish the overall materiality, we're going to establish the tolerable misstatement for the accounts and tolerable misstatement for disclosure. That's with the direct material. Indirect material, when we have some illegal act. So if we have related parties, means that if we are too much familiar with the entity and there's a related party inside, we have to disclose the name of the related party, nature of the relationship, type of the transactions, and the reasons entering into the transactions with the related party. What's the reason for that? This is for the auditor side. So which is the services that audit provided? Those are the services that audit provided in under the document audit strategy and audit plan and prepare the audit program. So again, we first identify the business, try to understand the business by going over the objectives of the business, strategy of the business, identifying the business risk. Is there any business risk? How those business risks are affecting the accounts, which accounts are affected, what's the audit risk in those related to those accounts, what kind of type of control the company exercise, and how this is going to affect our audit. So we following pretty much the same pattern over and over and over and over again. But I want you to understand the proper process, and because everything is in the audit is like a template. Step 1, step 2, step 3, step 4, step 5, step 6. Step 1, just 2. Now, what's going to change is going to change which account we're actually chasing. And what we're chasing, what kind of level of assertion, or what assertion we're looking for those accounts. That's with the type of the audit test. With the audit test, we have a risk assessment procedures, we have a test control, we have some substantive procedures. That's for the different things. On the substantive procedures, we have a test of the details, analytical procedures. So when somebody says what kind of procedures you're going to use for the audit, when they say substantive, I want you to understand that this will be test with the details. So we're going to test for the error, fraud, individual transaction accounts, balances, and disclosures. So you see how the logic goes. We start with the first one, which is the transactions. Then the transaction is posted in account. Then we're checking the account. The account is posted on the balance. Then we're checking that balance. And the other option, if it's not on the income statement or balance sheet, then it should be on the disclosure. Then we're checking what's the disclosure related to the transaction account balance on the disclosure. Now, when we're evaluating the financial information through the analysis, now that's analytical procedures, when we evaluate the financial information through the analysis, relationship among the financial and non-financial data. So now we're getting a little bit more holistic there to see how that event which is recorded affect the company itself. I mean, the event that is recorded, is it related to some bank covenants or not? Are they trying to do something to avoid Dual process testing. Dual process, we're going to test the control and we're going to test substantive tests of the transactions. So we're testing the control environment in the company and also the transactions that happen in the company. And materiality was the last one thing. The materiality is test for the materiality. First, we have to determine the overall materiality. Then we're moving to determine the tolerable misstatement. And the last one is to evaluate the audit findings that we have to do in order to assess that materiality. And which one is what to determine? We're going to have the quantitative benchmark and qualitative factors. So now on the quantitative factors, remember the order here. First, we're starting with the net income before income taxes. If that number is not appropriate, if you think that that number is not appropriate, then the next available comes is the total assets. If that you think is not appropriate, then we're moving to the next one, which is the total revenue. And keep going until you found the solid ground. But most common is income before income taxes. So if you don't go to the assurance, if you don't in CPA, if you don't choose assurance as a role, probably you're not gonna move. You don't have to move the income down to the next available level. And the qualitative factors that we have to assess is all those different factors. On the step 2, we're gonna determine the tolerable misstatement, which is the tolerable misstatement is the amount of the planning materiality allocated to the account and a class of the transactions. And the last one is to evaluate the audit findings. And that's about it. So now let's move to the next chapter. So now you can see how the process. So the other thing that we learn is what's the outcome of the audit. Audit of the coming comes with the 4 reports. One was unqualified, qualified. What was that? Assertion and disclaimer. Those are the four reports that you can come up with the materiality. On the audit, at the end of the audit. The other thing that we learn is that on the different level, different activities, I'll say activity, even though there's not activities, that we have to perform on the level accounts or transaction and the level of accounts. Let me bring those one back because I told you I want you to be comfortable with those. Again, we're not going to talk about this today. They're going to start coming at some point, but I want by the time they start coming, you to be comfortable with all the terminology. So this is related to the management assertion by categories and assertions about the classes of the transactions and the assertions about balances. So in the first case, we're chasing only the transaction and event that happen in the company and obviously related disclosures. And we're chasing occurrence, and please make sure what the occurrence means. If you have to bring it somewhere on the separate sheet by yourself and put some notes for yourself, please do that. If you're planning to go to the CPA, and if you're planning to go with the assurance, choose that as a profession. Please make sure you understand those assertions. Accuracy is the first one. Second is completeness. 30 authorization, accuracy, cutoff, classification, presentation. Where on for the account balances, we're chasing different things. We're chasing existence. We're chasing rights and obligations. Rights for the assets, obligation for the liability. Now we can start making logical connection. Then you're going to chase completeness, which is repeat with completeness on the previous one. Then you're chasing accuracy, evaluation, allocation. all those three together. Then classification presentation is repeating from the previous one as well, but are related to different things. Now we're chasing the account balances rather than transaction and events. So you can see we're starting with a very simple level. We start leveling on the transactions and events. Then we're moving to the next level, which is account balances. Then the next level will be statements. And the last level will be disclosures. But here with this level, we're chasing the assertion and accounts balances plus the related disclosure. Where in the transaction level, we're still chasing the disclosure. We're chasing the transaction and events plus the related disclosure, which are related to that transaction or that event. So that's overview whatever we did so far. I'll try to do this overview. Obviously, I'm going to have to shorten it, but to go over this overview every time, so you can understand the whole logic and to put all the audit process in your mind and start thinking about this auditing. So now let's go with the risk assessment. Now we have to start assessing the risk. So basically what we're going to do, we're going to do there's a director of the risk in Accenda. We're going to start doing her job, but from the auditing point of view. So let's see what we have to do. First, in order to assess the risk, what is the risk? Risk is that auditor express inappropriate audit opinion when the financial statements are materially misstated. So that will be the risk that auditor express inappropriate audit opinion when the financial statements are materially misstated. That is the audit risk. Now we're going to have the assertion level. And the assertion level is related to the financial statement level. And then we're going to go to, once we assess the financial statement level, then we're going to go to the individual accounts, balances, and disclosure. If we have to go to the transaction events and disclosure, we're going to go to the transaction events and disclosure. But again, the audit risk here is related to the risk that auditor express the risk that auditor might express the inappropriate opinion when the financial statements are materially misstated. So now let's see how we can mitigate that risk. So now we're going to the risk model. What affects the audit risk? Audit risk, so watch this, audit risk is equal to this risk times this risk times this risk. So now let's see which are those risks. First, we have inherent risk. Now, inherent risk is related to the some risk, which is related to the accounts and disclosure, and there might be misstatement due to the error and fraud that can be material before we consideration or any related controls. So the inherent risk in a way is the risk that exists in the company. Inherent risk is more related to the company business environment, company nature. That's on that level. Then we go into the control risk. Control risk is that misstatement that can happen in the assertions about the accounting balances that could be material might not be prevented, detected, and corrected on the timely basis by the entity internal control. So on the level of control risk, we're chasing what's the internal control in the company. Is that internal control at the company working? If it's working, are we satisfied with the level of that internal control? Is they actually doing the appropriate job or just pretending that they're doing something? Uh, can we rely on the existing internal control in the company? That's what the in this level the auditor looking for. Then we're going to the detection risk. Detection risk is the risk that procedures performed by the auditor to reduce the audit risk to the acceptable level will not detect low level, will not detect the misstatement that exists and could be material. That will be related to the inappropriate audit procedures, misinterpretation of the audit evidence, and failure to recognize a misstatement on the deviation. So those are the risks that may happen during the audit. Auditor may actually fail to those one and can fail to detect those misstatements. So we have all those risks: inherent risk, control risk, and detection risk. Remember those one because we're gonna need those one going forward. So now, how the audit risk work? Audit risk again is inherent risk and control risk. We're gonna be risk of material misstatement. We're gonna base our material misstatement based on the inherent risk and control risk. So basically, that's why materiality comes first. Once we assess the company, once we assess the risk in the company, environment, nature of the business, total business picture, the society, you can go with there, the country that the company is doing the business, what's the risk there? That will be our inherent risk. Then we're going to go to the control risk, which control risk is the risk that exists, the level of the risk assessment that existing in the company, anything related to internal control. The last one is based on those two, we're going to assess the materiality. The last one is the detection risk. So if the first two risks are low, we don't have to spend too much time on the detection risk, because the detection risk is the one that auditor actually assessing and applies, and if the first two are low, the detection risk can be a little bit higher. That's acceptable. But if the first two are high, then the detection risk has to be low. Because if the detection risk is also high, that means the audit risk will be high. So that means in order to reduce the detection risk, the auditor has to put more procedures, has to do more testing, has to spend more time in the company, and to make sure that there's no materially misstated account transactions events in the company. So detection risk is also related to the non-sampling risk. So if we not do sampling in the company when we're doing the audit, that increases the detection risk. And sampling risk is if you do the sampling but we're not doing appropriate, against that going to be. Now the audit risk in that case will be the risk of material misstatement time detection risk. That's another interpretation of the formula. Audit risk can be simply risk of material misstatement time detection risk. Why? Because the risk of material misstatement is equal to the inherent risk time control risk. Now, engagement risk, another risk here. We're going to have the litigation, then we're going to have the auditor exposure to financial loss and damage of professional reputation, and we're going to have that adverse publicity. So, usage of how we're going to use this risk assessment module. First, we're going to set the planet level of audit risk. we want the hour to audit risk to be that much. We're literally going to set up the number for the audit risk. And we're going to start chasing, can I reach this number? Second, we're going to assess the risk and material misstatement of risk of material misstatement, which is RMM, which RMM is equal to the inherent risk and control risk. So I'm going to assess the inherent risk and the control risk. And again, if I let's say my audit risk I'm setting at number 7, let's say audit risk is 7. So in order to reach 7, if this is let's say if this is 2 and this is 4, 2 times 4, I'm going down to now I have 8. What will be the number here that I need to achieve in order to get the R? So what I'm doing here is getting the 8 divided by 7 divided by 8, and whatever number I hear I'm getting, that should be my detection risk. So detection risk, so how much procedures you're going to put in the audit level on the time during the time of the audit will be determined by the detection risk. If you have to reduce the detection risk in order to reduce the audit risk, you're going to put more procedures. If you don't have to reduce it too much, then you don't have to put that many procedures. But do you understand this logic? Let me see your feedback on this. Do you understand this idea? Can you guys hear me?
Yes.
So do you
Yes.
understand the idea of the audit risk here?
Yes.
So we have an audit risk, which we're going to express it as a number again, which number is equal to 1 risk, inherent risk, time control risk, time detection risk. Auditor doesn't have effect. The auditor cannot affect the inherent risk and the control risk. The auditor don't have control of those risks, but the auditor has to assess those risks. The only thing that auditor has control is the detection risk. Why? Because the detection risk is related to the auditor job. Now, in order an auditor to achieve the number of the audit risk that he wants to achieve, since we don't have control over those two, and the last thing that we have is the control over the detection risk, so we have to come up with that detection risk by ourselves. And once we get the number of the detection risk, that will show that how much procedures and how much time we have to spend in the company in order to bring the audit risk to that level. So the auditor, we're going to use this level of detection risk to design the audit procedures that will reduce the audit risk to the acceptable level of that we already set up in the first place when we're setting the planet level of audit risk. So how are we going to use this model? If we want the audit risk to be very low, we're assessing that inherent risk and control risk, or which is the risk of the material misstatement, is high. That means the detection risk has to go down low in order to achieve very low audit risk. Now, if the second example, in the second scenario, if the audit risk is low, if the inherent risk and the control risks are moderate, then we can stay on the moderate level on the detection risk. Now, the last case scenario is if the audit risk, we want the audit risk to be on the low level. We already assessed the inherent risk and control risk, and they're on the low level. In that level, and then if those are low, then on the detection risk, we don't have to spend that much time. So the detection risk can be high. We're not saying that there's some misstatements. We're saying that we don't have to do many procedures because we already are comfortable with everything that the company is doing to detect those risks in the on very first level. So we as an auditor, we don't have to put that many procedures to find out what's going on in the company. So the auditor assesses each of the component of the audit risk model using the either quantitative or qualitative terms. So now, knowledge assessment. So for example 3 on the table above, why the auditor setting the detection risk high? And what does the high assessment of detection risk mean in the terms of the level of audit testing? What you're going to tell me here? So I want the audit risk to be low. I already assessed the inherent risk and control risk, or indirectly risk of material misstatement, and those risks are low. Why I can place the detection risk high, and what that high means to me in terms of audit testing. Talk to me, people.
Because the of the
Try and keep going.
uh,
Think. I want you to think and try it. Even if it's wrong, keep going.
I
Doesn't matter.
understand that if the audit risk and the control risk audit is like the company did allow procedures to detect this is
No,
high
listen.
is the high
So
level.
listen, before we continue, I want to make sure something that you understand. This is not low level of procedures. This is low risk,
Okay.
right?
That is
So
my question. Yeah.
watch this. In
Yeah.
what means low level of risk? That means the company doing a lot of procedures already. Do you understand the idea with the risk?
Yes.
So risk is high, risk of misstatement is high if the company doesn't do anything.
Mm-hmm.
There's no segregation of duties. There's no assigned policy for the members. There's no documentation. There's no any ethical standards and anything in the company. There's no on the internal control. We have to go to the 5 elements of the internal control risk in order you to see which one are those.
Okay. Yeah. In
So
this case,
right, if those 5 elements of the control risk doesn't exist in the company, the control risk in the company will be high because the company has a high potential to have something wrong there. So when the risk is high, that means the how can I say, there's no procedures in place. But when the risk is low, that the company applying all the policy on internal control, and the chances we to find mistake is very, very, very low.
yeah.
Make sense?
Yes, but I
Yes.
didn't understand why, if this case, example 3, the company have a low risk for the tech
Inherent
problem
risk, inherent risk and control risk. Yes.
because they have a very good control,
Yes.
internal control. Why detection risk is high?
Why detection risk is high? Because we
Yeah,
don't have to put too many procedures. We can rely on the internal control,
yeah,
right? We can rely on the internal control. If we test the internal control and the internal control doing his job, do I have to put too many procedures in my audit?
no,
No. But if I
yeah,
don't
doesn't
put,
make sense.
right, if I don't put too many procedures in the audit, that increase the risk that I cannot catch anything, something.
So,
But the,
so does it mean that the procedure that the auditor done is the auditor fails to
yeah,
detect that?
exactly. So in order to reduce the detection risk, I have to do substantial testing. So probably if I test every 10th transaction, I can reduce the audit risk to the level. Why? Because I'm trying to detect everything and to make sure that there's no mistakes,
Okay,
right?
I
But
get it.
but if the control risk already doing this, do I, as an auditor, do I have to do it again?
Yeah.
Make sense? So
Yes.
obviously I can rely on internal control. If I can rely on internal control, then I don't have to put that many procedures. If I don't put many procedures, then the risk I know to detect something is going up.
Yeah.
That's why the risk is high. I'm not saying that there is a mistake in this financial statements. I'm saying that I don't have to put too many procedures in the process of the audit. Why? Because I already have some control which I am assessing working. If the internal control do this job, then on the audit level, I don't have to be so meticulous, if you want. Make sense? That's why
Yeah, that makes sense.
in that case, the detection risk can be high. High doesn't mean that. Listen, the high risk. It doesn't mean that there's a chances of mistake. No, it means that if the detection risk is high, that means we're doing less testing, and the chances if there's a misstatement, we not to catch it are high. But the question is there anything like that if the internal control in place already catch everything? Obviously not. So that's why we can live with a little bit high the detection risk. So this is the trade-off.
Sorry, Professor.
Yes.
Like if the internal was like high, and
Oh,
then
then
means like you don't realize, so you do a lot of tests,
exactly,
and then the tension would be low because you are checking everything, right?
exactly.
But in this case, because it's low, you are not checking everything, so you can maybe you don't see some mistakes.
Right.
Okay, understood.
Yes. But the question is, if the question that you have to ask yourself is this: if they're already catching everything, what are the chances I to catch something?
Low.
No.
Low. So in that case, do I have to put a lot of procedures there?
No.
No. But if I don't put a lot of procedures, then the risk to not catch something getting high,
High. Yeah, because I'm
right?
not double checking everything. Yeah.
Right. I don't have to check everything now. But I'm not checking everything because they already have procedures in place which are reducing that thing. Make sense?
Yeah.
Yeah.
But usually that's how it works. You're always checking the control risk, and if the control risk is high on the audit level, when you start doing the audit procedures, you have to reduce. That means you have to put more hours, more procedures, more time for the audit. Where that's going to hit the client? Is that going to hit the client? Of course. Where? On the time spending on the audit. Then the client have to pay higher bill. Right? Everything comes with a cost. Either the client's going to spend money on the internal control, either the client's going to spend money on the audit. Now the client has to make sure he understands this, and he has to make a choice whether I want to spend more money on the prevention side or on the detection side, because the prevention side is the internal control. Obviously, on the inherent risk, there's not much you can do. you working in this environment. Then if the environment is risky, if there's a fluctuation of the current economic environment, if you related to the technology, if your business is now related to the relationship between the US and Canada on that tariff, obviously you expose no risk. Is there anything I can do there? Nothing. Inherent risk is just inherent risk. That's come with the business environment, with the nature of the business, with the current political situation and everything like that. So now let's see what they say here. Detection risk is set high because there's a low risk that is that a material misstatement is present in financial statements, and as a result, the auditor needs to gather less evidence. That's the explanation. We try to explain a different way. So basically, we're working with the procedures, which procedure is going to give you access to the evidence. Now, let's see the relationship of the entity business risk to the audit risk. First, we're going to assess the entity business risk. Look in the business, know what do we know about the business, what do we know about the business environment. Then we're going to relate to those risks that can go wrong at the accounting balance and disclosure level. Then we're going to assess the risk material misstatement. And that's going to help us to understand the inherent risk and the control risk. So assessment of the entity business level risk, that's related to the inherent risk. A risk related to the related those risks to the what's going on in accounting balances and disclosure, that will be on the control risk, how those are related. Once we're assessing the risk of material misstatement, we indirectly assessing those two risks. And once we come up with that risk of material misstatement, that's going to give us idea where should be the detection risk. Again, remember, the only risk that the auditor can control is the detection risk. Anything else, it has to be assessed. So which are the limitations of the audit risk? Audit risk model is a planning tool, again, but it has some limitation that must be considered when the model is used to revise the audit plan or to evaluate the audit results. So basically, we can adjust that model every time when we have to. And we can, even during when we start the, listen, the audit risk is set up in the beginning, right? Then you start doing the procedures. Let's say you're assessing based on the company information because you're doing some internal control testing. One on the level on the previous stage, right? When you familiarize yourself with the business, we're assessing the internal control and all those things that we learned on chapter 3. So once you do that, you start doing you're getting the detection risk. You're doing your, let's say you're going with the substantive audit procedures. You start checking something in the company. Once you start checking something in the company, you start finding things which you start questioning the internal control. And you're seeing that the internal control actually is not in place. Can I change your formula on this? Absolutely. You can adjust yourself during the audit process. Once you get the sense that, hey, internal control might not working here. So that means you're increasing the internal control risk right away. If you're increasing the internal control, you have to adjust yourself. So you have to start putting more procedures. So this model is only as good as the judgment and assessment used as input, and is not considered potential audit error. So again, the judgment here is very high, and assessment is also who's doing the assessment? Obviously, individual. Which judgment we relying on the professionals. Now, which professional is professional? That's a different story. Is it professional or professional but not that professional, or is it professional high professional? It's very hard to say. You can see in the And even in the level of the CPAs right now, you can see one CPA teaching courses, another CPA teaching courses, third CPA teaching courses, and all those CPAs, even though they finish the same program, they teaching the same courses, all the teaching has to be on the same level, but it's not. And you can clearly see that. From your perspective. So now you're thinking, so all those claiming that they're professional, but which one is the professional, or no, what is the professional? Do we have a professional, super professional, low professional? You see, always going to that judgment level, which is very hard to explain and very hard to justify. The other thing is that the desired level of audit risk may not actually be achieved. Why? Because there's so many things that can go wrong in the audit. Imagine you're assessing the audit risk on some level. You're going to the audit, you're finding out that the company internal control is not in place, not even close to what they're saying, and then you're trying to increase the detection risk, but you already signed a contract with this company for the audit procedures based on that you do on the preliminary findings from the company, preliminary assessment. You already signed a contract, so you already plan everything that you have to do based on the assumptions, based on the judgment that everything is in place. So now, even if you want to, you won't be able to achieve the level of audit risk that you want. Why? Because you cannot change the contract, right? So that's one thing. That's the downside. So what's the audit risk assessment process? Auditor perform risk assessment procedure to understand the entity and the environment that's related to the inherent risk. Then this understand to help the auditor to identify business risk and understand the potential misstatement of that may happen. Once we do that, we consider the responses of the entity to the business risk, leads to the audit to assess the risk of the material misstatement at the financial statement and assertion level. So again, first we're putting the assessment process to obtain understanding of the entity environment. That's our inherent risk. Then once we understand those risks, we're seeing how the business respond to those risks. So we try to understand how the business dealing with those risks which you were assessing in the first place. And that's going to help us for our materiality, to assess the materiality. Now I have to make this one bigger, so otherwise we're not going to see anything, at least not on the screen. So the perform the risk assessment procedures, so inquiries of the management and others. Then analytical procedures, including audit data analytics. So that's where the audit data analytics come in place. So what we can do here is, obviously, in order to do the data analytics, we have to have access to the company software. Once we have access to the company software, we can run different tests. From where they usually gathering the information. The easy way to get the information is from the reports that the company performed from the GST. That's one thing that the company, the auditors are relying from, because from the GST reports, in order to file the GST, watch the logic here. In order to file the GST, and the GST considered to be kind of solid evidence, because the GST report is sent to the government, and based on that report, you paying the GST that you do to the government. So the chances you to make something on that GST are very low. There's still risk of misstatement, but the risk of misstatement there is very low. So you're relying on that one. You're extracting all the GST reports. In order to get the GST report, you have access now to the invoices, which are reported on the GST site. And what you're chasing? You're chasing the input tax. For the input tax credit of the report, you extracting all the purchases. For the GST to pay, you get catching all the invoices with the clients. So you have your revenue and you have the expenses. The next thing that you have to do is start testing. Now, how we're going to do? We're going to include those data analytics, and you're going to do the random samples. You're going to find the repetitive clients. What's the balance? What's the highest balance? What's the lowest balance? What's the median? What's the statistical point? That's why here, if you want to go to the audit, you have to brush yourself a little bit on the statistical level. What's the average? What's the median? What's the high? What's the low? Mean of what means mean? Everything like that, because those are the terms that they're using in audit when it comes to the data analytics. The next thing you have to do observation and inspection to obtain understanding of the entity and entity business environment. So how are we going to do? We're going to check the nature of the business, industry, regulatory, external factors, objectives, strategies, business risk, entity performance measures. We're going to check the internal control. And once we do this, we're going to identify the business risk that might result our materiality and how we're assessing the materiality in the financial statements. So once we do that, then let's get it small now. How do we gather this evidence? So first was the overview assessment business process. So now how are we going to get this evidence? Well, we're going to start digging from everywhere, literally from everywhere. If you have to familiarize yourself with the business environment, that's what you have to do. If you have to familiarize yourself with the industry, that's what you have to do. If you have to familiarize with the regulatory requirements from the government, from anything like that, that's what you have to do. Obviously, you're going to ask from the management some information as well, anything related to the business. So basically, if this is the first audit, what do we need? Articles of incorporations. You want to get access to everything. All the documents that identify the company, if this is the first year or this is a new client. Any major contracts that the company making. Any purchase of the big purchases during the year of the assets, you want to know those ones. Obviously, you're gonna talk to the people inside. You're gonna start taking that if they have directors board meetings, minutes of those meetings, you're gonna access that information as well. Then you start doing your analytical procedures. Again, how are we gonna gather that the analytical procedures? Simple way. Access to the company information. Once you have access to the company information, start doing your testing. You know, it was very funny. What was that? One of the auditors, one of the companies that doing the substantial compilation review, the guy come to me and say, your company, you make a huge mistakes on the company and on the company GST reports. Again, they're going with the GST because the GST is solid ground. You have to understand this. GST is kind of solid ground. Why? Because it's related. The corresponding party there is the Canada revenue. So for that reason, the chances people to play with the GST is kind of low. It's still there, but it's kind of tricky. So anyway, the person who's doing the review of the financial statements come in and say, based on my calculation, the company owes $43,000 GST. And I said, I cannot comment on your calculation because I don't know what you're including in your calculation and how you come up with these numbers. But if you provide me the formula, how you come up with this, what kind of formula you're using, and what's your assumptions and how you come up with this number, then I can comment your calculations. So the guy said me this. What he's doing is he getting the revenue, total revenue for the company, apply 5%, getting all the expenses, applies 5%, and checking where is the difference. And then comparing the GST reports that the companies was submitting during the period, the GST is quarterly, and see if there's a difference. And there's a difference, right? 45 something difference. So he's sending me this calculation, and I'm looking at the calculation, and obviously it's a newbie who doesn't know how to do this calculation. And I said to him, okay, if you eliminate, because on the expenses, he getting all the expenses during the period, he getting that information from the income statement. Basically, he basing all his opinion on the income statement only. And I told him, if you eliminate the payroll, because on the payroll you don't pay GST, which is 2 million. If you eliminate the depreciation, which is, there's no GST. If you eliminate the bonuses, which there's no GST. If you eliminate this and this and this, we're getting very close. Our mistake is like a $10 on the GST. With the $10 mistake, I can live with. I don't know about you, but I can live with. So please check now my calculation and let me know if you agree. Well, guess what? I never get an email back from this guy. So for that reason, you have to be very good at accounting in order to come up with the proper analytical procedures. Once you come up with the analytical procedures, then you start doing observation and inspection. Means that going down to the transactions, going down to the clients, going down to this. So the simple way you to see this one, you to see all this process on the one place, and it's kind of, how can I say, standard way, a very kind of, not the standard, a very kind of outdated way I to tell you this because it's already been used a lot. Watch the movie Accountant and see what kind of approach he's doing by when he was asked to do assessment of the financial statement, how he come up with the assessment. He asked for the financial statements, no, 10 years, 15 years. Then he start getting out the balances first on the accounts. Once he get the balances on the accounts, he start to do analytical process, looking for and start observing and inspecting the balances in terms of ratio, in terms of the dollar amounts, differences between year after year. Once he find those things, then he go to the next level because you have the revenue expenses, revenue expenses, revenue expenses. If you see some irregularity, then you start going deep in the expenses, find out which accounts those expenses coming from. Once you found the accounts, then start putting inside the accounts and start chasing, is there anything in this account which looks suspicious? And that's how he found that on the expense side, there's a fictitious invoices with the client, which is the number of the generated by the random numbers generated. That's not a consistent number. So that's will give you the whole process, how you inquire the company information, how you do the analytical procedures, how to do the observation, and how to go deep in the inspection. And you moving, as you can see, you're moving from the statements into the accounts and the low level transaction and events. Okay, so understanding how we're going to understand, again, nature of the entity, industry and regulatory and external factors. Then we start, that's in the inherent risk. Then we start chasing the control risk, which is related to the internal control of the company. Once you get the internal control of the company, then you're going to go the objective strategies and business risks and entity performance measures. So now once we understand entities, so now we're going to go to the nature. To understand the nature of the entity, auditors should obtain information about the entity, business operation, the nature of the revenue sources, when they're recognizing the revenue, which model they're following. They're following International Financial Reporting Standards 16, I believe, in the revenue contract with clients. So that's why you have to be very good at now the financial reporting, because the audits, the understanding the nature of the business, you have to answer those questions which are related to the financial reporting, because at the end of the day, you're chasing what's happened in the financial statements and how they're recording those transactions. So you're chasing the revenue sources. We're chasing the product and services. Is it from the manufacturing? Is it the products and services? Is the merchandising company? Is the service company? What kind of company they are? Then how they conduct the operations. Do they have joint ventures? Do they have subsidiaries? Do they have their parents? Or what exactly they are? Do they doing some outsourcing activity? Which is the location of if they have a production facility, where is the location of production facility? So there's a mining company which the corporate office here is in Vancouver. The actual mining is in Africa. Do they have the warehouses? Where are the offices? Do they have office in downtown? Do you have office in Surrey as well? How many related companies are there? Is it the same umbrella? Is it the same corporation, or they're separate entities? What exactly happening here? The key customers. Which are the key customers? How can I get the key customers? Very simple. Get the total accounts receivables. Extract the accounts receivables that's sitting there for the company more than, or start chasing the balances in the accounts receivables. And if you identify the customer which has a higher revenue, let's say 20% of the company's revenue coming from one customer, that means maybe that's a key important customer. That's a key customer here. And the same thing with the suppliers. Check the expenses. See what's the relationship with the vendors. Is there any vendors which company rely on? And then see is that vendor is in the position that can keep doing what he's doing, because that may increase the nature of the business, risk in the nature of the business. Ownership governance structures, and investment activities in the group. Planning and recent acquisition, diversification, investments, disposition securities, anything like capital investments. Definitely capital investments means that you have to, one of the things that I told you for my auditor when I give him the reports within 30 minutes, one of the things that they want is if there are any capital purchases during the period, all the invoices to be collected. So keep that in mind. And every time when you start doing accounting for some company, every time when you see, every time when you're doing an accounting and you have to do the journal entry on the debit balance sheet account, any of the assets, make a copy of the invoice, put it in one file. Why? Because you need to know, you need to have copy for your purposes. What was purchased, when was purchased. In that case, you're going to have access to the, because don't forget, at the end of the year, all the invoices will be filed in some file, which file is going to be filed somewhere else, and that file is going to, all the information is going to get kept by 6 years. And after 6 years, you're destroying everything. That's another thing that you have to understand, and I want you to know. You're not keeping more information on the company more than 6, 7, or 8 years. Everything after that is destroy, get rid of it. But you need to know for how long you have to keep the accounting information by the Canadian regulations. So then we have to chase the financial financing activity and financial reporting. So what we're chasing here, as you can see here, the other way you can look at this process is in some way we're chasing the cash flow statement, we're chasing the operating activities, investing activity, financing activities, plus something else, which is the ownership governance and financial reporting. But in general, you can see business operations, investing activities, and financing activities. So what we're chasing, basically, we're chasing the working capital, revenue, expenses, anything like that, long-term assets, investment activity, long-term liabilities, equities, financing activities. And then we're chasing the ownership and the governance structure, and then we're chasing financial reporting. Once we have those one, we can say that, okay, I have kind of knowledge about the customer. Consider the entity that sells goods to the declining customer base. What risks does this entity face and how those risks impact the audit? Tell me now what you think. You can say whatever you want. Don't limit yourself to one or two things. Tell me whatever you want. Everything will be correct. I want to see you thinking rather than sitting there and do nothing. Tell me, what do you think about this? You're working with you consider the entity that sells goods on the declining customer base. What's the risk for the entity? And how those risks going to impact our audit? Tell me what you think.
Money laundering. No, I'm kidding.
Why money laundering? Why did you come up with this statement, money laundering?
No, I'm kidding.
So listen, if it's money laundering, first of all, they're not going to deal with the customers. They're going to go with the cash business. And if it's the cash business in the money laundering, you're not chasing declining customer base. Because if you're chasing declining customer base, that means you won't be able to money laundering for a long period of time. Also, you're exposing yourself for the risk to be caught. You're chasing the stable business, which mostly is done by cash. And that's how we choose in the money laundering business. You're not going to go with the declining customer base business. That's why I was thinking, that's why I asked you, why did you jump right away on the money laundering? Because again, if you're choosing this business for the money laundering, you already set yourself for failure. You have to be smarter than this. So let's go now. What's the risk that the entity faces?
In this
I
case,
think the risk of like misstating, because when you're in a business, it's easy for you to like misstate like the receivables and
Okay.
the inventory as well.
Inventory. Okay. What else?
yes, I think
Receivables from the
Okay,
customers.
receivables. So what is the risk here? No, forget about the balance sheets, forget about everything. What's the general business risk here for the company?
to the low the income.
Sorry?
To have a problem with the income, to load their income,
Okay.
because probably the customer will be closed the operations.
Okay.
And they lost-
This is the main risk. The company may facing the going concern here.
Yeah, they will lose some
Right.
in profit.
So
Income.
they're on the decline base. So they're in the business that it's going down.
Yeah.
In that kind of business industry. So what will be that business industry? That maybe probably they selling, they renting CDs players or movie CDs, right? So imagine this. We are now. Let's say, what was the year that the Blockbuster closed? Probably it was 15 years ago. So imagine we are now 2008. We have the Blockbuster as a client, and now we can see the trend in the industry. And obviously, that they selling goods. They selling, let's say, they selling those VCR cassette for the VCR players, which business started, which technology start dying, and we have to assess the risk that the company entity facing. What will be the risk? Risk is definitely company to disappear. Why? Because now we have to identify why that is the declining trend in the customer comes from. Is it because of the technology, or is it because of the down of the industry itself, which might pick up later? Is it because of the let's say, how about if they selling ski equipment 2 years in a row in Vancouver? There's no much snow. So obviously you've been on the declining kind of customer base, which may change next year if the conditions improve and we have more snow. Right? There's so many interesting things that you can come up with. Okay, how this going to impact our audit?
So there is a business risk with the audit procedures, and the material misstatement may be reduced so that the materiality of the financial statements is low.
Okay, so we're going to have a low number for the materiality, right? How about the audit risk? In order to achieve the number of the audit risk, what we have to do now? Now we have inherent risk, which is high. What do we have to do with the detection risk?
Medium to low.
We have to push it down low, right?
Okay.
In order to achieve the audit risk that we have in mind, once we see the inherent risk is high, that means the detection risk has to go low. Make sense? Okay, let's keep going with this. Industry, regulatory, other external factors. Industry, obviously, we're gonna go now, obviously, one after another. Industry, the market, competitors, cycling and the seasoning activity, production technology, energy supply cost. The regulatory environment will be accounting principles, regulatory framework of the industry, legislation and regulations, taxation, government policies, environmental, if there's any. Other external factors will be considered the general economic conditions, interest rate, obviously, and availability of the financing, and inflation and the current revaluation of the company. Now, then we have to check the objective strategies and the related business risk. That's now auditors gonna check the managerial accounting. How that's gonna happen, I have no idea. What the auditor usually don't understand anything on managerial accounting, but since you're coming from the advanced managerial, how the advanced managerial accounting course went? Did you guys pass?
Yes.
Good.
Yes.
Did you get good marks there?
Not in the last one, in the advanced.
Not in the last one. No, I know, but I'm talking about the people who took in last semester. I know you didn't.
I had advanced managerial last semester with
You
the
did too?
director.
Right. What's the marks?
Was bad.
Did you get at least C plus?
Yeah, I got C plus.
Well, that's what you need for CPA. So move on. For the advanced managerial accounting in the CPA, what you need is you don't need the managerial accounting itself. You need the governance. That's what it counts for.
Or C, I don't remember. I got it. I didn't do well.
So anyway, so that's what's coming. Objective, strategy, related business risks. So you have to understand a little bit about the governance, a little bit about the managerial accounting here. So what we're chasing, the entity objectives, what the entity wants, what's the strategy that the company using to achieve those objectives, and obviously once we know those things, now what will be the business risk, which will be associated with these objectives and the strategy that the company using. Then we're going to the internal control. Auditor needs to understand and assess the effectiveness of the internal control. We're going to identify the potential misstatement and the factors that affect the risk of those material misstatements. Also, we're going to assist. That's going to help us to, for us to come up with the audit procedures, appropriate audit procedures. Once we see the now the assessing the risk of the material misstatements. So basically, we combining looking at the inherent risk and control risk. One thing is, what's the nature of the error? Error, those are first error is unintentional misstatement of the amount or disclosure in the financial statement. That's error. Now, what's the fraud? Fraud is referred to the intentional act by one or more among the management who charge those charged with the government, employees, and third party involving use of the deception that result in the misstatement of the financial statements. So error is unintentional, where the fraud is intentional act. That's what we have to take out from here. And now the example of misstatement, which misstatement here, it might be based. Now, what's the nature of the misstatement? We're not checking the nature of the misstatement. We're just checking what's the example of the misstatements here. Inaccuracy in gathering or the processing data from which the financial statements are prepared. So basically the links in the accounting system are not correct. So basically when you post the client invoice, that doesn't reflect the revenue on the GL account. Omission of the amount or disclosure. So basically purposely we ignoring the sales at the end of the period. Why? Because we want to flip the revenue from one period to another period. But that will be intentional now. Financial statement disclosure that are not present.
Question, Prof.
Yes.
So in here, you're assessing the internal control of the business, right?
No. With this one,
That
we
yeah,
try
with
to
the inherent and control risk.
yeah, with both those we having in mind inherit and the control risk, but we're
Okay.
trying to more like to come up with the material misstatement here.
Okay.
Right.
Okay.
So
Makes sense.
here will be kind of different to differentiate which one is the related to the inherent risk, which one will be related to the control risk. We're just checking here what is the example of the misstatement that may happen. So which one will be the source of that misstatement? We don't know. Right? No, this level. So obviously, inaccuracy of gathering the processing data from which the misstatement are prepared, that might be related to the inherent risk. Now, but the omission of the amount or disclosure, that's definitely, again, that's no, that might be control risk, because the control risk didn't catch that one and allow them to not disclose something or not record something. Financial statement disclosure that are not presented in accordance with the general accounting principles. That's another example of misstatement. Incorrect accounting estimate from the overlooking the clear misinterpretation of the fact. What would be the example here? Accounting estimate. Accounting estimates come from the, let's say, the residual value for the long-term assets. So we were buying this computer do you know that there's a servers now? I check. I have to prepare one questions from another group, and there's a server which is server give you a highly kind of analytical functions inside the servers and everything like this. The cost of that server is $145,000. Crazy. Anyway, 145. So you're spending on the server $145,000, right? Top server, the newest level, and everything like that. And you assessing that after 2 years, the residual value of that server will be $100,000, which is ridiculous. That's never going to happen. And by the time you're buying it, probably the value of the server is already down to $100,000. Why? Because it's technology. In the 2 days, the price is going to go down. So that will be another incorrect, which is overlooking the clear misinterpretation of the facts. Judgment on the management concerning accounting estimates that the auditor consider unreasonable or accounting policies that auditor consider inappropriate. First thing will be probably estimates that the auditor consider unreasonable. That will be allowance for doubtful accounts. The auditor might disagree with your judgment. The accounting policy, it can be a treatment of the inventory, how you assess the inventory, or yeah, that will be appropriate thing. You're going with the first in, first out, when maybe the weighted average will be more appropriate in the inventory that you're running, something like that. So now, fraud. If you have the intentional misstatement, then we're going to go with the fraudulent financial reporting or misappropriation of the assets. That's where the fraud goes. Surprisingly enough, I kind of getting sense that a company here in even in Canada, they're running 2 sets of accounting. Anyway, now let's go with the misappropriation of the assets. Misappropriation of the assets involve the theft of the entity assets to the extent that financial statements are misstated. So what's happening here is the inventory that the company has is misappropriate in the let's say on every 3 computers that you're buying, the 4th computer goes somewhere else. It doesn't stay in the company. That means here we're going to have an example of the stealing the assets or paying for goods and services which are not received by the company. So we're making those sales, but the company doesn't get anything. And embezzling the cash received. Now, the embezzling the cash received, that's a very interesting term. It's more like a misappropriation of the cash at the time that has been received. Instead of going to company account, going to some other accounts. It was very interesting. One thing that's come in my mind is that one of the company that I was working one day, the person who's dealing with the PT cash, now the PT cash was done in a very interesting way. The PT cash is spent by the company, and when the fund, the PT cash goes close to zero, the check is issued for the amount of the exact expenses, and the PT cash is filled up again to the amount. Let's say $150 is the amount. So the person who's dealing with the PT cash was in the lock box in the drawer, which is also locked. So you need to have 2 keys in order to get the PT cash. The maximum amount that you can get from the PT cash is $150, which is ridiculously small. Most of the people in that company making like $30 per hour. So it doesn't make sense. Person for like he can reach $150 in one day to steal anything like that, right? So the chances here for the level of risk is very low for that amount of PT cash. Anyhow, the one day the person who's dealing with the PT cash comes to me and say, somebody stole the cash. And I say, asking, how did you figure out? Well, I'm missing. How much you missing? And she was missing $143.57. And I'm looking her and I'm asking her, so you're telling me that somebody opened the box, there was a cash inside, he took $143.47 exactly, left the other money there, and walk away? Is that what you're telling me? She said yes. And I said, that doesn't make sense. If I'm stealing something, I'm going to get everything. I'm not going to steal $143.47. If that's the amount that you're missing, there's something else going on here. Theft is the last thing that you, but she already spread the idea. She already sold it to the owners of the company that then we just hired a new accountant, and she come with the idea that the new accountant stole the money. And the owners of the company chasing me, coming to me, say, what happened? She stole the money. I said, that's a ridiculous statement. Please don't go that direction. It's very hard to make that statement because we missing the exact number of the old amount, which doesn't make sense. It doesn't make sense somebody to open the safety with the PT cash, steal $143.47 exact, leave the rest of the cash there. That doesn't make sense. So nothing happened with this. We couldn't figure out what's happening. She don't remember. She's the one who's dealing with the cash. She remembers getting the cash from the bank and such thing. So
But
what happened? So listen.
What do you think was the reason for that?
No, I'm going to come to the reason, and you're going to see the reason. So on that point, I left it the way it is because $147 with the company that making almost $4 million revenue. I'm not going to waste my time.
So it's not material enough.
Right.
Yeah.
So I'm not going to waste my time chasing $147 for which I clearly know that nobody can steal that amount. And she did something that she doesn't know what she's doing. Anyway, so she remembers getting the cash from the bank, but after that, she doesn't remember where she put the cash. So I said, okay, I'm not $147. I don't even want to look at it. I'm not gonna accuse anyone of stealing and anything. That's too much stretch. So I'm gonna leave it the way it is. It's gonna come from somewhere. Those money is gonna come. So watch this, what's happened. 3 months later, the same thing happening. Exactly the same thing happening. She's coming, say, I'm missing exactly the same amount. I said, now we become 2 times in a row, right? Now that's interesting thing. And the very next day, she's coming and say, I'm sorry. I actually deposit the money in my personal bank account. So instead of getting the cash from the cash, because the check is in her name, so she's supposed to get the cash from the bank and put it in the company safety PT cash deposit box. She depositing the check directly in her bank account without getting the cash. And I said, so what's happened in the first place? The very first time is the same thing. So please check everything before you start accusing people, because it's very, very easy to accuse somebody without have a proof of that, but it's very hard after that to undo what you already done. So now I want you to go to everybody, explain the situation, and apologize to the person that you accused that was stealing money. She didn't want to do that though. Right? We wanted to keep it quiet and to saying that something happened or something else happened, rather than everybody knows that she was depositing the money in her bank account. Anyway, so you can see that the fraudulent activity is actually, it can be misappropriation of the assets, not intentionally. I'm not saying this was intentional. That more likely follow in the category unintentional mistakes. But it still is a mistake. So now we have to assess is the level of control exists, and if the level of control exists, is the amount material or not. Fraudulent financial reporting includes the facts such as manipulation, falsification, or alteration of accounting records, or supporting documents used to prepare the financial statement. Why we want to do that? Because we have a problem with the compliance of the sum of the ratio or covenants, which we have to achieve. This one, misappropriation, internal omission from the financial statements of the event transaction is significant information. Why are we going to do that? Because we want to flip income from one year to another year, or expenses from one year to another year. Intentionally misapplication of the accounting principles relating to the amount, classification, manner, presentation, or disclosures. That's another fraudulent financial reporting implication. Now, fraud risk assessment process. How are we going to assess the fraud? Now, first, we have to find the source about the possible fraud. In order to find the source, first you have to understand, is there anything that makes you think that there's a fraudulent activities? Once you identify and once you kind of come up with it that there might be fraudulent activities, obviously you have to go down all the way to the source. What you think? Discussion amount among the audit team. Before you start discussing anything with the audit team, you have to have clear evidence that something going on. Don't go with the statements which might be too much stretch. The other thing is, once you do that, then you're going to start doing the inquiries to the management and the others. Then you have to follow the analytical process, investigation of the unexpected period and adjustments, and identification of fraudulent risk and factors. This is the possible the sources of the information about the possible fraud. So that's from where you can extract the information. Again, when you're extracting the information, you're not telling people why you're doing this. You're doing this quietly. You don't telling them that you're thinking about this fraudulent activities. In the contrary, you're not telling anything about this. You're just gathering the information. From where? For discussion about the audit team, you're going to try to understand more about the company. Is there anything in the previous years that might happen there? Inquiries from the management, you start asking, hey, can you please give me this invoice? Can you please this invoice? If that invoice is related to the contract, can I see the contract? Then you start analytical process. You start chasing, is this transaction repeating itself through the period? When was the last time that happened again? Is it in the line of the business? Is it not a line of the business? Is the amount in the same that happened over and over, or this is a random amount that happened only once? Investigation of the unexpected period end adjustments. So chasing is this happened during the close the year end, or happened somewhere in the middle of the year? And identification of the fraud risk factors. Then you have to identify, is this related to the unexisting vendor? Is it related to the unexisting customer? How often this customer exists, and all those different identification that you have to do. That's with the fraudulent activity. Let's move now to the triangle of the fraud. Now, three conditions usually exist when the fraud happens. First one is incentive. You have to have incentive, or you have to pressure in order to do the fraud. If you have the pressure, regardless what pressure, is it pressure because of financial reporting? Is it financial pressure? Is it because you're getting some advantages? Once you have that one, then the next thing that you're looking for is the opportunity. And once the opportunity happens, so you have the pressure, you see the opportunity, and once that happens, you're going to the realization. So the three elements we have: pressure or incentive, second one is the opportunity, and the third one is the realization. If you put person on the position and that person has a pressure or some incentive, what he's going to wait for? For the opportunity. Now, when the opportunity presents itself, he has two options. Either he's too dumb, cannot see the opportunity, either he's doing the opportunity, see the opportunity, and start realizing the opportunity. Now, the other mistake that he can do is that opportunity is going to happen again. He's going to realize it again. And then he's going to start depending on that opportunity realization, and that's how he's going to expose himself on the catching the fraud. Why? Because he's doing this over and over and over again. So what's your job as auditor? To see the opportunities. You to be able to see the opportunities. If you see the opportunities, then you can follow the fraud. If you don't see the opportunities, obviously you're never going to find the realization, because it will be very hard to catch. Is there any pressure or any incentives? Now that's on the personal level. If that's happened in the company, you can easily see the pressure or incentive. For example, the company is pressured by the bank to keep the current ratio to some level. Now we have the pressure. Then the company is going to look for the opportunity. What will be the opportunity? Simple opportunity is flipping long-term assets to the current assets, or not showing something on the current liabilities in order to increase the current assets and make the current ratio to look better. That will be the opportunity here. Realization is you checking, did they actually do this? So, but in that case, on the company level, you can start with the incentive and the pressure that the company can have. So risk fraudulent activity reporting is the excessive pressure on the management to meet the third-party expectations that I told you that this one will be the covenants from the bank. Financial stability and profitability and trends. So basically, if I'm exposed to the current trends on the industry, which reducing my income, my revenue, which my revenue is important so I can keep the earnings per share in the same, because if my earnings per share goes down, that means that my market price is going to go down, and then I'm going to start losing money. Maybe I can do something about it. The last one is the management personal financial situation and is threatened. So basically that will be on the personal level. So you can see on how many level that pressure can come from. It can come from the third party, can come from the profitability, and can come from the personal level. Now, opportunity. From where the opportunity can come? From everywhere. Because of the nature of the business, or the ineffective monitoring of the management, inappropriate internal control, complex of unstable organizational structure. So every time when you walk in the company, you one day you'll be accountant. If you walk in the company and you see that messy accounting in the company, which is not organized, there's no proper filing, there's no proper organization of the documents, you have to naturally assume something's going on. In what was that? You have to understand this. When the water is muddy in the river, that's where you can catch the big fish. When the water is clean, there's nothing. One thing you should know. So for that reason, you as an accountant, you have to see those things. As soon as you work in the company, you have to be able to see those things. You have to identify these things, and you have to make your judgment on those things. So the opportunity, and then we're going to the realization. Non-financial management, excessive participation, selective accounting principles, excessive commuting, aggressive or unrealistic forecasting, history of violating securities law and alteration the flow, recurring the attempt to justify the marginal and inappropriate accounting based on the materiality, ineffective communication of the ethical standards and selection of the appropriate ethical standards. Those are the realization that we can see. Now, the risk factors related to the misappropriation of the assets is, again, we have to, so now for, this is in general picture. Now I want you to see, this is the general picture for the business. Now, can we go one level deep? Yes, we can. What will be that? Chasing the accounts. Which accounts? Assets. What is the, now we have to find what's the incentive or what's the pressure of manipulating that particular element, what are the opportunities there, and what will be the possible realization. Then we can go one level deep and we can go to the customer. Is there any incentive we to deal with that customer and do something with that company? What will be the opportunity related to that particular customer, and what will be the realization? So we as an auditor, we have to already have to run those one to our head. So basically, you have to, in a way, think as a person who want to do something in order to catch these things. Let's see the knowledge assessment here. Which of the following is about the fraudulent financial reporting? We're chasing financial reporting.
It's letter A, Prof. The falsification of the inventory count, since
Right.
there is an intention of material. I mean recording of the account. B is unintentional. C is unintentional as well.
Right.
Recorded in D is unintentional. So
Okay.
just errors for B, C, and D.
Okay. Yeah, the letter E is the correct one. That's our solution here. So let's go with the process of responding to the risk of material misstatement and design the process of the audit. So what we're going to do first, we're going to assess the risk of the management material misstatement, which is the inherent risk and control risk. Once we do that, we're going to find the financial statement level risk and assertion level risk. Now, financial statement risk. Do those risks related to the pervasively to the financial statements? If the answer is yes, then we're going to go develop the response for that one. If the answer is no, we're going to determine what might go wrong with the assertion level. If we go that direction, we're going to have to decide, change the audit procedures to reduce the level of risk, audit risk. So now let's see what this one's going to tell us. Audit responses to the risk assessment results. So this is the possible responses. Assigning more extensive personnel. So if we find that there's a to respond appropriately to the financial statement level risk, we have to change something on the detection risk. What we're going to do? Assign more experienced personnel. Evaluate the sections selection and application of the accounting policy and incorporate additional element of the unpredictability of the selection and audit procedures. So basically, we try to be more creative here in our selection of the audit detection audit procedures in order to reduce our detection risk. Evaluation of the audit test results. So at the completion of the audit, auditor should consider whether the total misstatement caused the financial statement to be materially misstated. If that happened, then if the financial statement are materially misstated, then the auditor should require management to eliminate the material misstatement in order to achieve unqualified opinion. And if the management does not make needed adjustment, then the auditor should issue qualified or adverse opinion based on the mistakes now. So again, whether the total misstatement caused the financial statement to be materially misstated, if that happened, then we're going to the management and say, hey, please eliminate those ones. Fix those mistakes. If they refuse, qualify material. If the management not ignore us completely and they know that those mistakes exist, then we're going to the adverse opinion, which brings us to the point. Let's go and refresh ourselves on those opinions, and when we issue the qualify and when we issue the adverse opinion, because I still want you to know those things and always have it in mind. Because there's a little twist here and there which can change one to another. So watch this. What's the qualified opinion? When we're giving the qualified opinion, let me share my screen. So we're giving the qualified opinion that so we found that there is a misstatement. We consider that misstatement material. We tell the manager refused to correct the misstatement. Or auditor is unable to obtain sufficient appropriate evidence regarding the specific account. So there are two options here. Either the management, we find the misstatement, we're telling the management says, no, I'm not correcting this. That's enough ground to get the qualified report. Or we cannot obtain the sufficient appropriate evidence. We have to be sufficient appropriate evidence regarding specific account. Then we're going to issue the qualified opinion. Now let's see what's the adverse opinion. What's the difference between qualified and adverse? Adverse is suppose the audit financial statements contain misstatement. Again, we found the misstatement, we consider it material, which affect the interpretation of financial statement. Given such a situation, auditor will issue, so contain the misstatement, auditor considers material, some material that is pervasively affect the interpretation of financial statements. So you can see in this case that it's considered material, but it doesn't change the financial, pervasively affect the interpretation of financial statement. That's not the case here, but the management refuse to change it. Where here, we have this pervasively affect the interpretation of financial statements. Management is not even involved here. In that case, we are giving this adverse opinion. So let's go back to our slides and continue with our chapter 4. Don't worry, not much left. We're almost at the end. So now we know when I wanted you to see on which case we're going to issue the qualify and which case we're going to issue adverse opinion. Now, if the auditor determined that the misstatement is or may be resulting of the fraud and has determined that the effect could be material, the auditor should attempt to obtain audit evidence to determine whether in fact that material fraud happened. We have to consider the implication of the other aspect of the audit. What else in the audit this one's going to hit us? So basically, if it's revenue, where it's going to hit us? It's going to hit on accounts receivable. It's going to hit us on the cash. It's going to hit us on so many places. So that's why you have to understand the link. What is this? Where else is going to go? Discuss the matter and appropriate an approach for the further investigation with the appropriate level of the management. That is at least one of the level above those which are involved to committing the fraud. Now, if the owner of the company is the one who's doing it, I don't know which will be the higher level than that. Suggest that the appropriate level of the management control with the legal counsel and consider withdrawing from the engagement. So you might even consider withdrawing from the engagement if that becomes evidence for you. But again, what can I say? It's very hard to tell this is going to happen. The textbook, that's what says in the textbook. In reality, if that's happening in the reality, it's very hard to tell. It's very, very hard to tell. It's a very interesting ideas on the textbook. In reality, is different story. Documentation of the auditor's risk assessment. Now, what kind of audit documents the auditor should have? The auditor should document discussion among the engagement personnel, procedures performed for the identify and assessing the risk, fraud risk and other conditions, the nature, timing, and extent of the procedures, and the nature of the communication between about the error and fraud. And then we're going to the communication of the frauds and how we're going to communicate those frauds. Now, whether the auditor has found evidence of the fraud may exist, this matter should be brought to the attention of the appropriate level of the management. Obviously, what will be the appropriate level? One level higher than when the fraud exists. Fraud involving senior managers that causes material mistakes and financial standards should be reported directly to the audit committee. What if the fraud is done by the principal and he's the one who is in the audit committee? Then it's become an interesting story. Auditor should reach an understanding with the audit committee regarding the expected nature and the extent of the communication about the misappropriation by the low-level employee, and the disclosure of the fraud to the parties other than the client, senior management, and audit committee ordinary is not part of the responsibility, and ordinary would be precluded by the auditor's ethical and legal obligations, and except the following conditions exist: to comply with the certain legal and regulatory requirements, to a successor auditor when the successor makes the inquiries. So where we can disclose those one, if we withdraw from the audit, the new auditor comes and we can disclose those one with the one who's taking over. In response to the subpoena and to funding agency, other specific agency in accordance with the requirements of the audit entities that level the government financial assistance. Those are the places that we may have to disclose the fraud. Otherwise, everything is confidential. We have this obligation to keep everything confidential. Now, what I wanted to show you about the internal control. What do you know about the internal control? Tell me something that you know about the internal control. Do you know anything about the internal control? Very quick and very fast.
It has systematic organizational structure, Prof. Like, yeah. The designation of the responsibilities is um guided by the management. I mean, communicated with the management for internal control. That's my understanding.
That's your understanding. How about the other people understanding?
Was the internal control normally depends the companies, but there are more include their manual and process. They put the responsibilities and roles, and they have some documents that guide the person to do something or to act in the some way. They include maybe the ethics, process, and everything that's related with the company
Okay.
to perform the things in the better way than quality and avoid the risks.
So let's go again, the fraud. The fraud generally is dishonest act, which is on cost of somebody. Now, is it going to be the employer? Is it going to be third party? Obviously, in the audit process, when the third party is involved, since it's a public company, that might be the party which is impacted by the fraud. We're chasing for two things: opportunity or so first of pressure or incentives, then opportunity, and the last thing is realization. Once we have those things, we have once the realization happen, then we have a fraud. If we have the pressure and opportunity, that nothing else happen. All the three have to be happen in order we to talk about the dishonest act. Now, internal control. Internal control is the process which is designed to provide a reasonable assurance regard to the achievement of the company objectives, reporting, and compliance. How are we going to measure? Method and measures to adopt it to the safeguarding the assets, ensure the accuracy of the reliability of accounting records, increase efficiency of the operation, and ensure the compliance with the law and the regulations. So now, which are the 5 primary components of the internal audit, internal control? First, control environment. Second is risk assessment, control activities, information and communication, and monitoring. Principles of internal control activities. So if we go with the internal control activities, is first one is the establishment of responsibility. Second one is the segregation of duties. Third one, documentation procedures. Simply by numbering the documents and keeping that number in order, numbers in order, that's what documentation procedures. Physical control, which is going to help us to safeguard the assets. Then we're going to have independent internal verification. Somebody in the company internally is going to verify. Then we're going to have the human resource control, which will be related to the employee's duties, background check of the employee, and make sure that they're taking their vacation, that they have to take vacation, and everything that they have to do in order to make sure that they're not realizing the opportunity that may happen. So again, human resource control, independent internal verification, physical count, documentation procedures, safe segregation of duty, establishment of the responsibilities are the one that we're looking for, which is the part of the principal internal control activities. And that's the only thing that I wanted to show in the internal control activity. I'm not going to give you anything more on this one. I don't want to make sure this, I don't want to make this one about the internal control. We are on the audit, which audit assessing the internal control. So let's get rid of this slides and stay with our slides that we have here. So that's for today. This is the chapter for today. This one is interesting chapter. I know it's getting a little bit deeper on the level of control in talking about the different type of things, but it's interesting you to start developing that way of thinking about the control, about the audit procedures and audit process. So next time, what we're going to happen next time, let me fast forward on the next lecture, which is chapter 5, and we're going to start gathering the evidence and documentation for our audit. So in order to do that, what we have to do is first, obviously, we have to open the slides for chapter 5, and after I do that, then we can go quickly over those ones and to see the relationship of the evidence and in order to, so what we have to do is first, the objective is to come up with the audit report. Now, in order to come up with the audit report, we have to follow some steps. The audit report obviously will be the last one. So we're going to check the management assertions. Again, we start talking about the assertions level with the transaction events that we already talked about it, and I show you today. Then accounting balances. We're going to go again about the level of assertions that we have to do. We're going to repeat those level of assertions. Audit to start gathering the audit evidence. What's the nature, sufficient, appropriate evaluation of the audit evidence, and we're going to see which is those one. Again, we're chasing the level of assertions, which are communicated with the Canadian audit standards 3.3.15. Those not random coming from somewhere. And then we're going to start getting with the nature of the audit evidence, which one is sufficient, which one is deficient, which is higher, which is lower. Relevance and reliability. We're going to start talking about the quality of the audit evidences. Then we're going to see the proper evaluation of the evidences. Then we're going to see that how we're going to audit procedures. That will be the key here. The audit procedures. Once we get the audit procedures, then the audit procedures is part of the audit process. So we have to understand this. And then we're going to start going with this terminology. What is the vouching and which level of assertion we're achieving by vouching, and what's the tracing and which level of assertion we're doing by tracing. So that will be a little bit too abstract in the beginning, but I want you to practice it. Because again, if specifically, if you want to go to the public practice company, I want you to be comfortable with this terminology. Assertion, and which is the activity that we doing in order to make sure that this assertion is achieved. So if you're chasing occurrence as assertion, through vouching, we can make sure that this assertion level happens. If you're chasing completeness, then by tracing the activity that we have to do is tracing in order to achieve that level of assertion. So that will be a little bit interesting here. And then we're gonna go with the, again, with the how we're gonna obtain those audit evidences. And we're gonna go with the type of evidences, and then we're gonna go with the desired level of the assurance and the evidences that we want to gather in order to achieve that desired level of assurance. And then we're gonna go with the examples of how we're gonna test the accounts payable. And the audit documents again, the content of the audit documents, what will be the difference between the current files, what's the difference between the permanent files, which we have to keep in our records. If you don't keep those records, I think CPA doing a review of all the practitioners about the documents that they're keeping. The purpose of analytical procedures, what we need those analytical procedures, and develop of the expectations when we're doing the audit, what were the expectations. And as you can see, a lot of interesting things, but at some point is a dry theory, right? Because we're not doing the actual audit here, we just keep gathering information, familiarizing ourselves with the terminology in order to understand the whole audit process until we finally start going deep down and start doing the actual audit by having ideas what kind of procedures or what kind of activity we have to perform in order to gather the information that we want to gather, right? That will be our audit stuff. Again, besides the purely theoretical part, we can say that audit is kind of interesting thing in terms of gathering the evidence and confirming with the evidence. But some of you may think different. And I don't blame you for that. Again, audit is not my original preference. Questions?
None so far this time, Prof. Thank you so much.
So now,
So far.
your assignment for this chapter it's not done yet. So I'm gonna do it right now, and you're gonna have access to your assignment for this chapter. I wanted so there are two ways to do the assignments. To go ahead before we do the lecture or after the lecture. So now once we know what we discussed during the lecture, I can test you on the things that we already discussed. So that will be a proper way for you. At some point I have to throw you one quiz. So I'm thinking to throw you quiz for chapter 1, 2, and 3. What do you think? Or shall we include chapter 4 as well?
No, 1, 2, 3.
1, 2, 3. Okay. 1, 2, 3 deal. We have a deal. So so listen this. There are a lot of chapters here. We have in total we have how many chapters we have? There's a lot of chapters. 18 chapters. Going over the 18 chapters during the time of this course, that will be unrealistic. So at some point I'm going to start skipping the chapters and I'm going to go to the chapters that I need you to know, which will be valuable for the CPA. That's one thing. The other thing is that at some point I have to decide what exactly to test you on the midterm and the final exam. So I'll try to make it more practical rather than test you on the theory that later on there will be no application of that theory. Make sense? So if I give you questions, I'm going only the presumptions that whatever I'm testing you on, you're gonna need it later on in your journey for CPA. Right? Everything that I'm thinking that's not gonna be needed, then I'm not gonna test you on that one. I hope that give you idea, and I hope that makes sense.
Okay.
Okay.
Okay. The 1 second.